Here we are in early 2023, and there's definitely a lot more optimism in the housing and mortgage markets. And a lot of that is to do with the outlook for Fed rate cuts early this year. Right now, everybody's waiting to see when the Fed is actually going to initiate their first cuts. We entered the year thinking that maybe it was going to be as early as March. Remember, this time last year, everybody expected that we were going to be entering a recession in 2023. I admit that I was in that camp, and I thought we were going to see it in the latter half of the year, and we were going to see mortgage rates drop down to the low sixes to high fives. But instead, what we saw was higher than expected GDP. We saw a strong jobs market, and we saw a resilient consumer. And therefore, instead, we saw the 10-year Treasury spike up and yields hit 5% in October. And as well, the 30-year fixed rate mortgages followed suit, and they spiked up to the high sevens, even 8% in some cases. So I got some things right in 2023, and I definitely missed some things in 2023. What are we looking at for 2024? Here's my forecast. First up, interest rates. We saw a peak in the 30-year fixed rate in October of 2023 when it hit 7.79%, according to Freddie Mac. And then we saw a rally going into the end of the year. And as we sit here today, we're below 7%, and we're sitting at about 6.69%. Now, this followed the 10-year Treasury, which peaked at 5% in October and once again rallied through the end of the year. And as we sit right now, we're at about 3.92% on the 10-year. Now remember, the 30-year fixed rate mortgage closely follows the 10-year Treasury yield. And historically, the spread between the two has been about 1.7% roughly over the last 50 years. But in the last year and a half, that spread has increased significantly, and we've seen over the last year basically about a 2.7 to 3% spread between the two. Now, one of the reasons for this increase in the spread is, aside from the fact that the Fed raised the Fed funds rate significantly in the last couple of years, they also engaged in what's called quantitative tightening. So previously, during COVID, they were doing quantitative easing, which is basically pumping a bunch of money into the economy. And part of doing this was buying of mortgage-backed securities, which increased liquidity significantly in the market, and it decreased the spreads and also decreased the interest rate on those. Now, in quantitative tightening, they exited the market, and therefore with that decrease of liquidity, the traders demand a wider spread. Now keep in mind, if we do see some compression in that spread back to a more normal spread of 1.7 to even 2%, we're going to see a significant drop in the 30-year fixed rate mortgage without any lowering of the Fed funds rate or any move by the Fed. And so right now we would be a full percentage point lower. We would be sitting at about 5.7% on 30-year fixed rates, just with the spread getting back to that normal. So the expectation coming into this year was that the Fed was going to cut. They signaled to the market earlier that it was going to be roughly about 75 basis points in cuts in 2024, and many predicted that it was going to start as early as March. Now, with the strength in the economic numbers, and then with the Fed meeting today, that March cut does not look as likely. As a matter of fact, based on the Fed Fund futures, that has dropped to just about a 35% chance that they start their cuts in March. But May looks on the table still, and right now we're looking at about an 85 to 90% chance that they cut at least a quarter point at the May meeting. So based on the Fed's higher for longer talk, I expect that we're going to remain in this upper 6% range on 30-year fixed rate mortgages for the foreseeable future, at least through the first quarter. I think that as we head into May, if that cut looks likely, that we're going to start to see a drop in rates in anticipation for that. So my expectation is we're going to see probably May, June timeframe for the 30-year fix to start to come down. And for the full year, I anticipate that we're going to see somewhat in the low 6% range, possibly end the year with rates in the high 5% range. And one thing to keep in mind, don't discount the effect of an election year. So next up is home prices. Last year, my prediction was we were not going to crash in home prices and we were going to see roughly a flat for the year, plus or minus 5%. Well, we ended the year up 3% with a median home price across the nation of $415,000. For 2024, I expect that we're going to see continued appreciation. My guess is we're going to see roughly about plus 4 to 5% in appreciation. And I think a lot of this is going to obviously be due to the decrease in interest rates that I'm expecting, as well as inventory shortfall, which we'll talk about next. Inventory continues to be a problem.
So overall, I think 2024 is going to be a good housing market, better than last year at least, which is coming off of a low base. And I think it's going to be priming up for a very robust 2025 housing annual basis. Mortgage market.
They ended the year at $4 million. For 2023, existing home sales were roughly about 4.1 million for the year. And at the end of the year in December, for reference, on a seasonally adjusted basis, we were at 3.78 million. Now, existing home inventory is roughly at about 1 million units. And keep in mind, again, for a frame of reference, back in 2007, entering the financial crisis, we were at 4 million units. And in 2014, at the peak, we were at 2.3 million units. So inventory has been and will be an issue going forward. We have right now about 70% of homeowners that are sitting on a mortgage rate of 4% or lower. Now, many of them don't want to swap out to a higher interest rate. As we get into rates coming down, maybe low sixes, high fives, we are going to see more people willing to make the move. Life happens. There's move-up buyers, there's events, kids, job location, etc. So we will always have that, and we're going to have more people that will essentially throw in the towel and say, okay, it's time that we make the move. But that's not going to outstrip the demand. There is a ton of pent-up demand out there, and when mortgage rates get down into that level as we anticipate, it's going to bring in a lot more affordability to these people that are sitting on the sidelines as well. So I continue to see that being a problem going forward. So as far as inflation is concerned, we continue to see signs of cooling inflation. The Fed's favored gauge of inflation is personal consumption expenditures, which is PCE, and they are looking at a target growth of 2% on core PCE, which strips out food and energy. And last week, we saw the most updated readings, and it was 2.9% on the 12-month core PCE and 2.6% on the headline number. Now, the 3 and 6 month core PCE were actually under 2%. So we're definitely getting much closer to their target.
As far as the recession is concerned, the general consensus going into 2023 was we were going to have a recession in the latter half of the year. Now, obviously, that didn't play out. And heading into 2024, most economists have flipped and think that we either have achieved a soft landing or will achieve a soft landing in 2024. And now the contrarian in me is saying, well, if everybody's thinking that we will not have a recession, maybe we actually will. And the reason that we may is if the Fed digs their heels in the sand and go with the tighter for longer policy that they're doing currently and don't initiate the rate cuts until too late, because the policy right now is very restrictive. So the real rates, the real interest rates are restrictive currently. And if they hold on too long, then inevitably we could go into a recession. I'm not saying that we will, but there is the possibility. So I'm just going to keep watching the labor market as we go forward. There have been a few signs of weakness, wage growth, things like that. But overall, it's still been very resilient. but I'm going to keep watching the labor market. Remember, if we go north of 300,000 on initial jobless claims for any duration, 4-week average or more, then we could definitely tilt into that recession category. So that's where I'm at on the recession. So what does this all mean for the housing and real estate market in 2024? Well, I believe that existing home sales are going to grow this year with the lower interest rates. I think we're going to see a 4.5 to 4.75 million on the existing home sales off of the base of about 4 to 4.1 million from last year. I do believe that interest rates are going to go down, as I mentioned before, and we're going to end the year either in the high fives or low sixes. And I do believe that now is a good time to buy if you can afford the higher rate. And the reason I believe that is not necessarily it's definitely going to go down and you can refinance, but if that does play out like I expect and rates do go down, I believe that the competition is going to increase to the point where it's going to outstrip any inventory that comes to market, and therefore right now you can take advantage of concessions. There's a lot of home sellers that are willing to offer concessions and home builders that are offering concessions, and that can go toward closing costs, it can go toward rate buy downs, things like that. If we get into the scenario that I expect with lower rates, more competition, you're not going to see those concessions and you're not going to have that availability. The real people that's going to hurt is first-time home buyers, because in a more competitive market, home sellers are going to go with people that have higher down payment or cash offers, things like that. So it's really going to hurt first-time home buyers. So I know that affordability is definitely an issue still, but if you can afford it, I think now is a good time to get into the market. So overall, I think 2024 is going to be a good housing market, better than last year at least, which is coming off of a low base. And I think it's going to be priming up for a very robust 2025 housing and mortgage market. Stay tuned.